Hi, welcome to Christensen Wealth Management. I'm Michael Christensen. Thank you for taking time out of your day to watch this weekly stock market update for the week ending Friday, January 25th, 2019, that is. Before I jump into the charts and commentary, I would like to begin with the quote of the week. And this is a anonymous quote that I like, and it says, "You can't do much about the length of your life, but you can do a lot about its depth and width." Those are some wise words from whoever wrote it. Anyway, the stock market has been on a tear since the day after Christmas. We've had a very significant bounce, but what you need to know is that most of the indexes have only got back about half of their losses from the high of October to the Christmas Eve and Christmas lows. So for those of you who may think that we are out of the woods, first of all, we've only bounced halfway back. Two, the volume of trading on the bounce since Christmas is very, very light, meaning the enthusiasm as the price is going higher on the stock market indexes is getting lower and lower. Lower enthusiasm means no one is willing to buy the stocks as they go higher. Or I should say, fewer people are willing to buy those stocks. So right now we are just kind of out of gas. The stock market has gone sideways now for, let's take a look, 1, 2, 3, 4, 5, 6 days. And not sure if it's a topping process and we're about ready to head lower, but I am keeping an eye on that possibility. I think that the lows of Christmas should be tested, meaning we should go back down about 10% on the Dow, S&P, and NASDAQ, and Russell 2000. But that's certainly no guarantee. It's just something I'm watching for. As far as the indicators go, for those of you who are feeling like everything is back to normal and blue skies are here again, keep in mind that the Dow Jones Industrial Average, the S&P 500, and the NASDAQ are all still below their 200-day moving averages, which is a bearish situation. But even more bearish is the fact that the 50-day moving averages are also below the 200-day moving average, which is very bearish on the long-term time frame. On an intermediate-term time frame, all of the indexes, Dow, S&P, NASDAQ, Russell, have the 20-day moving average below their 50-day, meaning over the last several weeks, we are also in a bearish configuration. The only thing that is bullish is the fact that the 5-day moving average is back up above the 20-day moving average, and that is a short-term indicator. So we have all these things: declining volume of trading, intermediate and long-term indicators are bearish. We've only bounced halfway back on this stock market, and the Dow and S&P, and for the most part the NASDAQ, are all below their declining trend lines, meaning if you connect the high of October to the high of December and you draw that line out, then you can see that we are still below the declining trend, which means that we are still in a declining trend until that is broken. Let's take a quick look at that, and then I've got some other things I want to talk to you about. Let's look at the Dow, S&P, and NASDAQ charts really quick. Here is a 5-month chart of the Dow Jones Industrial Average, and if you connect a line from the high of October 3rd to the high of November 8th, and it projects down to the high of December 3rd, and you draw that out just like that, that is the what we call the declining tops resistance line. As long as we are below that line, the Dow Jones Industrial Average is still in a declining trend. And here we sit with a gap between where we are today, which is the 24th of January, and that red line. In order to get up and touch that, which is always a possibility, but in order to get up to there, we need to rally about, looks like 2% on the Dow Jones Industrial Average to get to that line. If that line breaks and we start to move higher, then definitely there are some storm clouds that are moving away, but if we stay below that line, caution should be used. Let's take a quick look at the S&P 500. Here is the 5-month chart of the S&P 500. If we connect a line from the high of October 3rd as well, draw that down and touch the high of December 3rd and project that forward, you can see that we also have not reached that, which means the S&P 500 is still in its downtrend, and we have only bounced back a little over 50% from the distance of the high of October 3rd to the low of Christmas. So, in fact, also, in order to get to that red line, the S&P 500 would need to rally about 1.75% to get up to that line, and we'll just have to see if that happens. Now let's take a quick look at the NASDAQ 100. Here's the 5-month chart of the NASDAQ 100 stock index, and if you draw a line from the high of October 3rd to the high of December 3rd and project that forward, you can see that on the 18th of January we broke above that line, but then on the 22nd we fell back below it, rallied up to just close on the line on the 23rd, which was Wednesday this week, and then on Thursday this week, the 24th, we closed above the line again. So it's trying to get above that line, and we just need to see where this thing wants to go. But it is getting a little bit tired because of how vicious and fast this stock market rally has become since Christmas. And we have a trend like this from the bottom of Christmas to January 3rd and up. That is the trend that this particular NASDAQ 100 index is following, just like that. And as long as that's holding, there's some strength here, but it is worth watching because the rally has been so fast that it's getting a little bit tired and due for a pullback. And I want to see that pullback before I get myself a little more bullish in the NASDAQ 100. So right now, just use caution over just the next few days, and we'll see where this thing goes. Okay, so those are some very valid reasons for remaining cautious. Again, only the short-term indicators are looking good. The intermediate and long-term indicators are all still bearish, and we have only had the monthly indicators turn bearish recently for the 4th time in 20 years. So prior to the 2000 market decline of 50%, the monthly indicators turned bearish. And prior to the 2008 54% decline, those monthly indicators did the same thing. We had a false alarm in 2016 that was reversed by the election of Donald Trump, but now stock market valuations are extremely high and much higher, like 20 to 25% higher than they were when Trump got elected. So valuations are at extremes, and we just got that monthly bearish warning signal again recently. But I have some other things I want to walk you through. I'm going to look back over the last 30 years and show you why there are some other things that keep me cautious here at Christensen Wealth Management. I want you to look at the colored lines, which are the moving averages of the charts I'm about to show you. Don't worry. I will walk you through these step by step and show you how today does not look very appealing for investors compared to the rallies of the past 30 years. Let's take a look. Okay, here's a chart of the Dow Jones Industrial Average over the last 2 years. Now, don't get too uncomfortable with all the lines on here. The Dow Jones Industrial Average is the black line. I will tell you what these other colored lines are in a moment, but if it makes you feel any better, I will turn those off and just show you that line right there. That black one is the Dow Jones Industrial Average. Now, I'm going to turn these on. This is the 50-day moving average. This is the 75-day moving average. Again, just the average of the Dow Jones Industrial Average over these time frames. That's all it is. Here's the 100-day moving average, here's the 125, here's the 150, and here's the 200-day moving average. Now, I'm going to turn off the Dow Jones line and just leave the moving averages. Okay, so what we have left now is just the moving averages, not the actual price of the Dow Jones Industrial Average. I want you to watch the moving average behavior at the beginning of the last market rallies that we have had over the past 30 years. Let's go ahead and go back to the beginning of the last one, which started in 2016. Before I talk about 2016, I want you to take note of the portion right here, which was the summer of 2015. And let's go ahead and make that a little different. There we go. So this section here, you can see that all the moving averages were rising, and then all of a sudden in July of 2015, the moving averages all started turning down below each other. And then one at a time. First the 50, and then the 75, and then the 100, and then 125. And by the time we got to, looks like about right here, August 28th, when the stock market started dropped 10% in about 6 days, all of the moving averages were below each other, pointing down. Then we had the 50-day shoot up, and however, all the other moving averages were still not very responsive except for the 75-day. And what I want to show you is this here, this circle, was the beginning of a very turbulent time, and that was a perfect time to remain cautious because all of the moving averages crossed below each other and started heading lower. Now, once this was over, let's take a look at how the moving averages reacted when we began the last big market rally in 2016. Right here in about April of 2016, represented by this circle right here, you can see that one by one the moving averages, starting with the 50 in red and then the 75 in gold and so on, one by one they all started crossing up over each other. And right here I will draw a line representing each one of those moving averages. So one by one, each of these moving averages started to cross up above each other. The 50 crossed above the 75, right? Actually, let me move that right there. And then we had another one. The 75 crossed above the 125 right there. And what I'm saying is, as these moving averages started to cross each other, that is when an investor wants to become more and more aggressive with their investments. And the last one that crossed was in fact right over here in August of 2016. So if I zoom out a little bit and show you what happened after that last crossover, then we basically went all the way up here without all those moving averages except for in here in November of 2016, which was the election. All of the moving averages were in really good shape until we got to about up in this range. Now, what does that mean as far as point gain? Well, if you were to invest in your in the Dow Jones Industrial Average somewhere in this area, looks like we would have a gain of approximately 37% over that time frame, anywhere from 35 to 37%. So what I'm trying to get to through to you is you can see in this range right in here, all of the moving averages are heading higher, and they're all pointing in the upward direction, and they are in declining order. The top one is the 50, and then 75, 100, 125, 150, and 200. That's how they're supposed to be in an uptrend. And you can see from the prior, then once you can see up here, if I want to move that over here, you can see in this area everything started to go haywire again in January, February, March, April, May, June of 2018. And we have since, if I move it over, we have since gone into kind of chaos mode right here, and everything is looking extremely bearish. And so what I want people to understand from all these lines and colors is you want to invest your money in a period that looks like this, or in the beginning of a rally, which might look something like down in here. But you do not want to be aggressive with your money when all of the moving averages are crossing below each other like they are right in here in the last 3 or 4 months of 2018 and early 2019. These signals are all bearish. Only the short term, which is not represented here, is bullish. So that is the point that I'm trying to make with the Dow Jones Industrial Average. And if I were to switch over to the S&P 500 and just show you the exact same thing, you will see that it looks very much the same. This is the last example and probably one of the most powerful examples to show you, and that is what happened as we entered the late stages of 2007 and early 2008. And up here you can see that first of all we had a final rally in 2006 up to the top. And what happened right in here about December 2007, January 2008, all of the moving averages started turning down below each other. And by January of 2008, all the moving averages were bearishly configured, one below the other in sequential order. And the last one happened about right there. And you can see that as of that point, the stock market just fell off a cliff, and the whole way down, these moving averages, for the most part, the longer term ones, stayed bearish all the way down to the bottom. And it was here in May of 2009 that the short-term indicators started to trigger and turn up above each other, giving investors some confidence to start dipping their toe back in the pool between right here. And the last one to turn was the 150 and 200-day moving averages, and that one happened about August of 2009. So in that period of May to August of 2009, all of the indicators started to turn up above, and then after that we had nice symmetrical lines going all the way up until 2010. Then we had some bumps in there. It's nice symmetrical lines up and then some bumps, and then we really took off up here in 2013, and really as of right here it was just full speed ahead. All the lines were properly configured all the way up to the highs of 2015. So that was 2 years of smooth sailing all the way up into here. And again, all I want to say is right now, in closing, everything looks pretty ugly up here. None of that is good. All indicators are turning bearish, and we have 2 more left to go. But I wouldn't fool around with this level of negativity one bit. So caution is warranted. Thank you for watching my video. Before you go, please do me a favor and click the subscribe button on this YouTube channel, and then click the little bell next to it so you'll be notified whenever additional videos are posted. And when you have time, go to the summary description of the video or to the top right-hand corner of christensenwealth.com, and you will find the social media links to the page of Christensen Wealth Management at Facebook, LinkedIn, and Twitter. Like and follow those pages when you can, so I can communicate with you throughout the week on social media and through these videos. I hope you found the charts helpful, a graphical representation of how mixed, or how negative, I should say, not so much mixed, everything is right now. Please use caution, and remember that getting back to even is not an investment strategy. And as I said in prior videos, yes, the stock market has come back and rebounded for 140 years, but the time you spend going nowhere, or the time lost by losing money in a bear market, you can never get back. And it often takes at least 5 years to go down with the stock market and get back to even. We don't have 5 years to waste. So anyway, have a great day, a great week, and I wish you a very enjoyable weekend. Bye-bye.